will add giving up too much control too early. Knowing that there might be multiple rounds of this and understanding how that's going to play out from an ownership perspective is something really important to consider. In this episode, we dive into the world of venture capital, unpacking how startups secure major funding, what VCs are really looking for, and the high-stakes trade-offs founders need to understand. Please subscribe to our podcast to stay updated, and for more information, visit our website at profspirit.com. Also, if you know someone who might enjoy our content, please share our podcast with them to help us grow.
The Let's Get Entrepreneurial podcast is your ultimate launchpad for igniting ideas and skyrocketing your entrepreneurial dreams. Your two hosts will be Professor Gary Palin and serial entrepreneur Ryan Budden.
Good morning, Professor Palin. How are we today?
Doing very well. How are you doing?
Brilliantly, as always. We've gotten together today to talk about VC companies. If you're listening to this and you haven't caught our episodes on bootstrapping and angels, I'd suggest you start there because we're basically going in order from the earliest stage money to the latest stage money, and also typically in order from the smallest amounts of money to the largest amounts of money. We won't rehash those episodes here, but I would encourage you to go back and have a quick listen to those so you have an idea of what we've been building to, which is the flagstone product of entrepreneurs getting money, which are VCs, also that stands for venture capitalist funding.
And that is very typically sequential, and it's not unusual for a company to be involved with all three forms of financing.
No, it's very typical that they do that, actually. Start with family, friends, and fools, or bootstrapping. Then they get an angel to get them over their initial inflection point when the business starts growing. And after they have some real sales behind them, or at least some proof in the pudding, then they'll go to a venture capitalist firm to get a large source of funding.
Absolutely. It's very standard.
What is a venture capitalist firm? A lot of people in entrepreneurship have heard that, but they're not really sure what that actually means. To break that down, they're just professional investment organizations. They've essentially made a company out of figuring out how to invest in startups or early stage companies that they believe have maturity potential. And they have systems and processes in place to help give that money out and then also help the company grow.
VC is really a fund manager, and they invest capital from usually one of three sources: institutions, corporations, or high net worth individuals.
That's exactly right. Yeah, you can see the money sources coming from a lot of different places. But the thing I want to emphasize on this is professionals. This is what they do for a living. All of the other funding we've talked about thus far is a lot less emphasis on processes and procedures and the need for items to be presented in a certain way.
When we touch on angel investors, it's their money. They don't have someone to report to. With a VC, it is not their money. That's very important to understand that. They have to report to someone else. And so therefore, those other individuals or institutions or corporations, they want specific types of information. So therefore, it's going to be more formatted.
Exactly. The way you present materials, the way there's due diligence done. Due diligence is the period in which you're getting to know this VC fund to see if they are going to give you the money or not. It's their research into your company. That process can be quite arduous because it is regimented.
Venture capitalists will recruit the funding from those individuals or institutions I mentioned in a specific fund. And it's based on the performance of that fund will determine how much money they can raise in the next fund, which will be determining how much money they can raise in the next fund and the next fund. So their performance is measured by other people. So henceforth, they tend to become very formal and they're very professional about it.
Let's quickly go over why you'd be looking to work with a VC fund. It's typically money. Their investments range from $500,000 to 20 plus million. Especially in the last few years, we've seen VC funds able to achieve quite a huge scale of investing above that 20 million. And they are looking for high growth businesses. Previously, we talked about angel investors. They obviously want the highest growth of their money, but they're targeting somewhere between 4x and 5x. And just to repeat it, 5x just means 500%. Whereas VCs are really looking for high inflection points, and they're looking for 10x returns.
It's a numbers game for the VC also. What I've seen is the funnel is for every 1,000 businesses that they will be approached with, they will seriously look at 100. They will fund 10, and one will be the one you read about in the paper. That's the big home run that creates most of the activities. There'll be 2 or 3 that make money. The others tend to limp along, or several of them just die off. So for every 1,000 that they peruse, there's one that's the big hit.
That's kind of an amazing statistic, isn't it? It shows why sometimes the initial conversations with these firms can be arduous and pretty drawn out. Now, the other positive to working with large VC funds is their event horizon. So when they're looking to get their money back is fairly long. I don't know an exact number on this, but from VCs that I've worked with in the past, it's somewhere between 5 and 10 years.
That's referred to as the exit strategy. When you're speaking with the VC, you want to talk about what your prediction for that horizon in exit. And it's not necessarily your exit as the entrepreneur, it's their exit as a funder of this.
Correct. So whether you're selling the business, whether you're going public with the business, or whether you're raising another round that ultimately has them exiting from the deal.
You want to understand the type of VC firms that you're working with. Do your research on what is best for you as opposed to the type of VC firm. So for example, some only invest in early stage. Some won't invest in early stage. Some look at growth stage. Some are sector specific. There's also corporations that have a VC arm. You want to understand who you're approaching. So don't approach a company that's looking for a growth stage and you're at early stage. You're just wasting your time.
You are wasting your time. And the gatekeepers, if you will, typically won't be the ones to tell you that you're wasting your time. You will have to figure that out by yourself.
Yes, and sometimes they are very curt in telling you that it's a waste of time.
Yes. I was trying to be nice in phrasing that. It's a very difficult aspect of working with VC funds.
Their time is money also. They don't have a lot of time to play around, and they will be very, very direct.
We've talked about their VC funds' typical investment dollar amount. We've talked about length of time they're looking to stay in an investment before there's an exit strategy or an event horizon. But let's talk about the life cycle of these investments. A lot of these words might sound familiar to you if you're getting into entrepreneurship, but we'll kind of lay them out for you. We talked about a seed round. A seed round is typically the very first round of large money that you're going to take. And it can come from an angel investor, again, which we spoke about in a previous podcast, or it can come from the first VC fund that you interact with. From seed funding, you then have what are called series rounds. And there's series A, B, C. You can just keep going up the letter list if you need to. But each series is an inflection point in the business that a larger scale of money gets contributed towards to continue that rapid growth of the business.
If you project out, let's say you're projecting out to bring it to its entirety, to develop it fully so that it's an acquisition target, and you project that it's going to be $100 million, you're not asking for $100 million in the seed round because you're giving up too much equity for that. So you will do it in stages as you need to build to each stage. It gives you a greater valuation, but also it's an easier commitment for the venture capitalist not to throw everything into this high-risk venture. They want to see performance and milestones.
They're looking to be able to grow with the business, but make sure that business is growing before they go all in with you.
They will be looking at specific milestones and they will be looking at performance. And also it's important to understand that they will have a seat or more on your board of directors. If you're not performing and they think it's because of you as the leader, they will replace you.
Yes, and there are some very famous examples of that happening. Steve Jobs has to be the biggest example of being removed from his own company when large-scale funding was brought in.
I'm sure the initial thought from a startup entrepreneur is they can replace me. It won't be my business anymore. First of all, it could be a good thing. I found very often individuals are good at certain stages of the entrepreneurial growth, but they're not as good as the next stage. So you may be great at bringing it to a specific point as a startup from nothing to a specific point, but bringing another person that the VCs have connection and experience with, that could be a great thing for you because you still own the same amount of the business. You haven't lost your business because you've lost your CEO title. If they bring someone else that can catapult to beyond your abilities, you've made more money.
You're making a lot more money because they're not taking your ownership away. They're just taking your title away at the company.
I've seen it happen where it's an excellent thing for the founding entrepreneur to be replaced as a CEO, but it's important to understand the VCs can't have that level of control with the board of directors. As you mentioned, Steve Jobs is a great example. Who would have thought that's possible, but they have that much control.
And then they brought him back. So they even have that control.
Yeah, that doesn't mean the board of directors makes the right decision.
Yeah.
Very often I find that there's questionable decisions, but it goes back to the golden rule of business. He or she with the gold makes the rules.
That's exactly right. So if you're following along with this conversation, you're probably wondering to yourself at this point, we said that from 1,000 companies that a VC looks at, they invest in 10. So when you're doing this approaching, you're looking to be 10 out of 1,000. So how do you stand out? How do you become one of those 10? From my experience, there are certain things that no matter what VC, they're looking for similar things. Those things are the founding team. So what experience do you have? How coachable are you? What sort of domain eminence? What is your background that you're bringing to the project?
That's the most important one in any form of investing is the founding team. If I was looking at the family, friends, and fools, if I'm one of the family of fools, I would still look at the management team. Granted, grandma's a little bit more flexible with the granddaughter or grandson, but that founding team is critical no matter where you are. Even if you're starting with a bootstrap, if you have a team you're bringing together, you want to analyze, should I invest my own time because of the founding team? That's critical in my mind.
The next thing they're going to look at is market size. With the idea or the company you're bringing, what's the total addressable market? They're not going to be interested in investing in mittens for kittens that have some growth defect. There's only a few of them out there, and they're not going to be able to scale it very quickly. They're looking at large markets where they can get that return. After that, we have the problem solution fit. Are you clearly solving a problem with your business or idea?
That market fit is so critical in any business you're doing, but you better be able to present that when you're presenting to the VCs.
Next, we've already touched on this a little bit, but they're looking specifically at scalability. Do you have the potential to scale in this industry? Because there are some industries where that's just not going to happen. And is their amount of money going to achieve the scalability that you say it's going to?
That's the type of return they're looking for. It's very large returns they're looking for. And if it's not a scalable component, they're just not typically interested.
After that, they're looking at traction and KPIs. We've talked a lot about this on this podcast. I'm a huge fan of KPIs, measuring growth. They're going to be looking at how are you measuring growth, and is there that traction that you're claiming there is? And then the last thing that I've found to be very common is the exit potential. So are they going to, at some point, be able to recoup their costs? Because there is a chance that they invest in the company. You are super successful. You hit all of these other metrics, but there's not really an opportunity for you to go public, sell the company, or get another investment. So they're not going to recoup their funds.
They don't want to own a business. They want to exit and have a profitable exit. Whereas the entrepreneur, very often they want to own the business. They want to operate the business. They're looking at a long-term perspective. The VC is not. So that exit and the viability of an exit is important. Another one we've alluded to that's intertwined in that I always like to present is, what is the sustainable competitive advantage? Because I may have a market opportunity, it may be scalable, I may have a business model, but if it's not sustainable, if other people can come in and easily replicate and gain traction on that, that will make a VC a little hinky on getting invested in this business. So can I sustain that competitive advantage? Protected IP is an example of being able to sustain a competitive advantage. And if you're in an IP play, you better have your IP protected when you're talking to the VC, because they will just walk away from you so fast if it's exposed.
Or you run the risk of the idea being taken by somebody that does have experience at that level.
The VC funding process, you're pitching to the VCs, and usually it's a group of VCs that you have to secure the agreement. There's a due diligence process that they'll look at your business model, market, financials, legal, etc. And then if all goes well, you receive a term sheet, and it has the basics of the valuation, ownership percentage, liquidation preference, board seats, other things, but that's the types of things you'll see on there. And then you close the deal and you fund the round. There's been some major companies that have been tremendous success. SpaceX received $2.1 billion in VC funding.
In the very beginning, when I was saying the typical metrics go up to 20 million, there have been some big examples of recent where 20 million doesn't even compare to the amount of money they've been able to receive.
Because you receive VC funding doesn't mean you're going to be successful. I'll try to think of one of the more interesting ones. I don't know if you remember Friendsters.
Okay. By name only, I can't remember what they did.
Friendsters was pre-MySpace, then pre-Facebook. And they were the first ones into that social media. Facebook and MySpace crushed them. And they tried to pivot into gaming unsuccessfully, and they crashed and burned.
And I'm sure they raised a significant amount of money.
They raised $50 million, and we're talking a number of years ago at the beginning of social media. The reason I think of them is I was actually on a judging panel at Stanford for a business plan competition with the founder of Friendsters.
That's amazing. Looking back at this, are there any red flags that stand out? You know, we talked about the pitfalls of both angel investments and bootstrapping. What are the pitfalls, oh no, get out of this deal, that we can attribute to VCs?
I would say, just in a final takeaway, understand that VC financing isn't for everyone. It's a strategic tool. A pitfall is people think it's just a cash grab. It is far from that. And if you think you're in there for a cash grab to get multiple millions, if not billion, you're in the wrong place. Also, big mistakes that people make is make sure your vision aligns with the VC's expectations. That misalignment can cause really serious problems down the road. And do your due diligence on the firm that you're looking at just as much as they do due diligence on you. Those are some key areas that I'd conclude with.
I'll add giving up too much control too early. Knowing that there might be multiple rounds of this and understanding how that's going to play out from an ownership perspective is something really important to consider. And the other one, and this might sound counterintuitive, is taking VC funding before you're ready. I have worked as a consultant with multiple companies that have taken VC funding before they were equipped to handle that amount of money. And it has caused massive fractures in the company because you essentially, once you have that money, you are expected to spend it and spend it quickly to get that growth going. And if you're not ready for it, that is an enormous amount of pressure that's about to be dumped in your lap.
Yeah, I'd agree with you 100%. It can be a bad story. Preparation and understanding and research, understanding where you are is critical to increase the odds of it being a success.
Without a doubt. Let's get entrepreneurial.
Let's get entrepreneurial.
We extend our gratitude for your presence and attention. Check out profspirit.com to discover resources and courses designed specifically for innovators like you. Stay on the cutting edge by following us on Spotify, Apple Podcast, YouTube, and other platforms as it is released. Until then, keep the entrepreneurial flame burning.